Good morning, everybody. As Tom said, I'm Tammy Skoglund, and I work for Bakke Norman and Richardson Tax and Accounting. Today I'm going to talk about some income tax updates. I'm going to talk about the laws as they currently are for 2013 and the laws as, well, we'll see them probably likely unless Congress enacts some legislation for next year, for 2014. I'll also talk about some tax planning things and some reporting requirements that are in place right now for most of our farm and business clients. I just want to mention we've had a couple changes with Richardson Tax and Accounting in the last several months. One big change that we had was we have a new accountant. His name is Paul Cruz. He's here with us today. And Paul, will you stand up again? This is Paul. So if you want to introduce yourselves to him, if you're Richardson Tax and Accounting client, you'll be working with Paul and with me. So you'll see him in the future. The first slide here is a little comic strip that says, well, you made more money last year than you did the year before. You people never learn, do you? Which is kind of appropriate and fairly telling as far as the changes that were made to the tax code for 2013 tax year. The first of such changes is that there's a new income tax rate of 39.6%. The other rates are the same as they were in 2012, but there's an additional rate. And as you can see from the two different tables here, that individual filers hit that 39.6% bracket on income over $401,000, or $400,001, I'm sorry, and married taxpayers at $450,001. So that new bracket is in place. In addition to the additional tax bracket, high income taxpayers are subject to what is called the net investment income tax. And this is a tax that came into play as part of the Affordable Care Act. And individuals with more than $200,000 of income and married couples filing a joint return with more than $250,000 of income pay an additional 3.8% tax on what they call net investment income. And there's a calculation to figure that out. It's either on the net investment income, or if your modified adjusted gross income goes over the threshold, there's a calculation to determine that amount. Investment income is income from things such as interest and dividends, non-qualified annuities, royalties, rents, gains on disposition of property, so what we refer to as capital gains, and certain other income derived from trades or business. Common types of income that are not investment income are things such as wages, unemployment compensation, retirement plan distributions, income from a non-passive business, Social Security benefits, tax-exempt interest, and self-employment income. Some other changes this year: the standard deduction for single filers is $6,100. For married couples filing a joint return, it's $12,200. Personal exemption is $3,900 per filer and dependents. Something else that's new this year is the medical expense deduction. If you itemize and have been ever able to take medical expenses as an itemized deduction, the threshold for claiming these last year was 7.5%, and this year it's 10%. So you can only deduct medical expenses that exceed 10% of your adjusted gross income. There is an exception to this. The exception is for individuals age 65 and older. They will continue to be able to deduct medical expenses and use that 7.5% threshold for tax years 2013 through 2016. Married couples, if one of the taxpayers is 65 or turns 65 this year, that threshold applies to both if you're filing a joint return. Capital gains. There's one change to the capital gains rates this year as compared to last year. And that is for those people that find themselves in the 39.6% tax bracket. Their capital gains will be taxed at 20%. If you're in the 10 or 15% tax bracket, no tax on those long-term capital gains. And if you're in the 25, 28, 33, or 35% tax brackets, capital gains will be taxed at 15%. Qualified dividend income is taxed in the same manner as capital gains, and that includes those in that top tax bracket that will be taxed at 20% for those capital gains. Short-term capital gains, same as last year, and short-term capital gains are for assets held less than 1 year. Those are taxed at ordinary income rates. Some other changes for those high-income taxpayers, and high-income taxpayers for these purposes are defined as single taxpayers making $250,000 or more a year, and married couples filing joint returns who make $300,000 or more a year. And there's a limitation on itemized deductions. So basically what this is your itemized deductions are limited, and this the limitation reduces the amount a high-income taxpayer can take as an itemized deduction based on a calculation that's done. For those high-income taxpayers, there will also be a phase-out of personal exemptions. So if you're in those high-income levels, you could see your personal exemptions completely phased out. Another tax that's new this year is the hospital insurance tax, also called the additional Medicare tax. This is an additional 0.9% tax that applies to earnings above $200,000 for those single filers and above $250,000 for married couples filing joint returns, and the tax applies to all earnings. Earnings would be wages or other compensation, and if you're an employer and you have employees that are reaching that $200,000 level, you need to begin withholdings on those wages that exceed $200,000. One credit that's still in play for 2013 is the American Opportunity Credit. This credit is for higher education expenses for the first 4 years of college. It's $2,500 credit for each eligible student. However, there is a phase out, so for those high income taxpayers, you may be in that range where this credit is phased out or you don't get it at all. This credit was extended through the end of 2017. The alternative minimum tax exemption amounts have finally been permanently indexed for inflation, meaning Congress doesn't have to go back, or at the end of every year doesn't have to enact legislation for the AMT exemption. This year, the AMT exemption amount is $80,800 for married taxpayers filing a joint return, and $51,900 for single taxpayers. On the federal side, for depreciation expense, Section 179 is limited to $500,000, and that deduction is reduced dollar for dollar for purchases exceeding $2 million. This 179 expense is valid on new and used assets and certain software. And you can just read things that it applies to are machinery equipment, special use or single-purpose agribusiness buildings, such as bins, drying systems, and livestock barns. Does not apply to machine sheds or shops. Bonus depreciation is still in place this year, too. Deduction is 50% of the purchase price. It applies to new assets only with depreciable lives of 20 years or less. And when we figure out the depreciation, we take 179 and then bonus. If there's any remaining basis in that asset, then that's depreciated over its useful life. Now we'll talk about some Wisconsin tax laws. There was a change in the individual tax brackets for Wisconsin. We have 4 tax brackets. There were 5 last year, the 4 for 2013. Most people fall into that 6.27% bracket. For married couples, you fall into that bracket if you have income between $28,000 and $315,000. So they're capturing most in that tax bracket there. Wisconsin depreciation is the same as it was last year. It's limited to $25,000, and the deductions are reduced for purchases that exceed $200,000. There's also no bonus depreciation allowed in Wisconsin. Credits available this year. The Wisconsin Manufacturing and Agricultural Credit. This is new this year. It is a credit that goes up every year. It's based on manufacturing and agricultural. And this year it's 1.875%. I did put a handout in the packet so you can read a little bit more about that. We haven't actually seen the form. That comes out sometime in December. So once that form comes out, we'll know a little bit more about that credit. But that credit goes up every year, and in 2016 that credit is 7.5%, so that likely could offset a lot of Wisconsin income tax. Other credits that are still available this year are the Dairy and Livestock Farm Investment Credit, the Farmland Preservation Credit, the Dairy Manufacturing Facility Investment Credit, and then the Beginning Farmer and Farm Asset Owner Credit. Moving on, this is what we think is going to happen next year. This is, unless Congress enacts some legislation, this is what next year will look like. The first 4 things on the list here are just annual inflation adjustment items. So the first one, the taxpayers that are going to be affected by that 39.6% tax bracket are singles who make more than $406,000 a year and individuals who make more than $457,600 a year. Standard deduction increases. It does every year for inflation, so next year it'll be $6,200 for singles and $12,400 for married couples filing a joint return. The personal exemption increases to $3,950. And then a couple other items that the estates of decedents who died during 2014 will have a basic exclusion amount of $5.34 million. And the annual exclusion for gifts remains the same for 2014 as it is this year, and that's $14,000. One of the big changes that's going to affect our farm clients is to the 179 expense deduction. Next year, it's going to be limited to $25,000, and that deduction is going to be reduced dollar for dollar for purchases exceeding $200,000. It's going to apply to new and used assets as it does this year, and to the same machinery and equipment. Also next year, there's no bonus depreciation. So the most we're going to be able to expense for those asset purchases is $25,000. On the state side, 179 expense is going to remain at $25,000. So for one time in a long time, federal and state are going to be the same. Wisconsin is not allowing bonus either. Some credits that are expiring for Wisconsin that will not be available next year are the Dairy and Livestock Farm Investment Credit, the Dairy Manufacturing Facility Investment Credit, and the Beginning Farmer and Farm Asset Owner Credit. We'll move on now to tax planning, just some ideas for individuals. You can bundle itemized deductions by making an extra mortgage payment by the end of the year, paying your real estate taxes in full before December 31st, increasing your charitable contributions, or paying medical bills. However, you want to keep in mind that for those under 65, you can only deduct expenses that exceed that 10% of your adjusted gross income, so that may not be a great option. For businesses, once again, you can prepay some expenses. You can deduct purchases paid in the current year that will not be used until next year, but you must be a cash basis taxpayer. The prepayment must be for an actual purchase and not a deposit. And the prepayment must have a business purpose and not be for tax avoidance. So a business purpose, you're locking in a better cost or you're getting discounts, that's perfectly fine. Deferred payments, you can defer some payments. However, you should have a contract in place before the grain or commodity is delivered to the buyer. And the contract should specify that seller has no right to the proceeds until the following year. Moving on to record keeping and reporting requirements. We get a lot of questions about 1099 reporting. And generally, farmers and other businesses are required to file two types of 1099s. Form 1099 miscellaneous, which is required for payments of $600 or more for rents and services, so services such as hoof trimming. And they're required for payments of at least $10 in royalties. Form 1099 interest is also required, so this must be filed if $600 or more of business interest is paid to an individual, partnership, or LLC. A 1099 is not required for payments made to a corporation, for payments of merchandise, freight, or storage, or for payments made to a tax-exempt organization. In order to report these 1099, or to comply with the 1099 reporting requirements, you need to request taxpayer identification number. And the form you're supposed to use to get this information is a Form W-9. This is used to get taxpayer identification number, and it's a form that is to be filled out by the person who you're going to pay, and they're to put their name, address, and social security number on that. And just a reminder, according to the IRS, you cannot request a taxpayer identification number over the phone. So the best way to get somebody's identification number is to get a W-9. We've been seeing several notices come through from the IRS to our farm clients where taxpayer identification numbers and names are not matching the IRS's records. If you get one of these notices, you're required to send what the IRS calls a B notice to the people whose numbers, the person or people whose numbers don't match. And with that B notice, you need to send a W-9. If you have just made a mistake in transposing their number, you don't have to do anything, you just have to correct your records. If they've given you the wrong number or you just don't have the right number and you don't get the correct number from them, then you have to begin backup withholding as you would if they were an employee. So you have to begin backup withholding, and that's 28%. So if you don't get the correct numbers, you're required for withholding that and depositing that money with the IRS. There are also penalties for not complying with that. It's $100 per number that's off if you don't get it corrected. And if you don't do the backup withholding, the employer or the person making the payments becomes responsible for that 28%. So that's quite a hefty penalty. So I can get you these forms. You can get them online. Eventually, we're going to have a website and for Richardson Tax and Accounting, and we'll have links to all these documents. And I'll send out some more information with our tax letter to our tax clients regarding these requirements and how you can get forms and information if you've gotten one of those notices. Make sure you either let me know or you're complying with what it says on that notice so you don't get penalties assessed. There are also some reporting requirements due to the Affordable Care Act. Many more requirements for businesses, including small businesses, which do affect our farm clients. Employers must provide a notice to their employees whether or not the employer provides health insurance. And what this notice is for is to tell the employees that they need to have health insurance and where to go for the exchange. You have to direct them to the appropriate exchange in the state. If you have employees and they live in Wisconsin, Wisconsin doesn't have its own state exchange, so they need to go to healthcare.gov. If you have employees that are in Minnesota, MNsure, M-N-S-U-R-E, is the exchange in Minnesota, and you need to direct them to go there. I've attached, there is a handout in there, the Farm Tax Saver. Employers with less than 50 employees are not required to provide health insurance, but you still have to provide that notice to employees saying you need to have insurance and you need to go to the exchange if you don't have insurance. And this will explain that a little bit more, and if you have questions, you can give me a call.